Introduction. The concept of value investing came in 1934 in security analysis work of Benjamin Graham and David Dodd. Later, Warren Buffett, coached by Graham, was to become one of the richest men in the world and considered by many the best investor of our time, using the concepts of value investing. Because of this, Buffett is considered the leading popularizer of value investing. The first point to be savvy when it comes to value investing is the difference between value and price. Value is something intrinsic to the company, i.e., a company has high or low value depending on its quality as an organization, regardless of its current price. Price is the monetary amount which the market assigns to a given company at a given time. It may be greater or less than the actual value of the enterprise. Especially in the stock market, the law of supply and demand works too hard. If many people are selling a stock, the price of it falls. If enough people are buying, the price of the same stock rises. However, the value of the company remains the same, and the company has not become better or worse in the low or high of the share price. If it is a stable company, it remains stable. If it is profitable, it is still profitable. Thus, value investing refers to make a qualitative analysis of the company in which it intends to invest. The investor of this type of the principle that buying shares is becoming the partner of this company. Because of this, he must believe in the growth potential of the company, or his investment makes no feeling. Understand the concept of value, which is better, to buy shares at a price below the value or above the value. Of course, it is better to make the purchase with a price below value. Importantly, in value investing, you should consider the purchase of shares actually as an investment in the purest meaning of the word. That is, the investor buys such shares because he believes in the value of a particular company and wants to be part of the same owner, i.e., to be a member. If you invest in a good company, the ups and downs of the stock price should not affect you, because regardless of the stock price, the company's value follows the same. Chapter 1. The Father of Value Investing. Benjamin Graham, the father of value investing and fundamental and valuation analysis, was famous for being teacher of billionaire Warren Buffett. If you want to learn how to invest well in stocks, you need to know Benjamin Graham and his investment philosophy in action. Why is Benjamin Graham important? Every investor who starts their investments in stock exchange always faces the debate: what is best, technical analysis and value investing? As Charles Dow can be considered the father of technical analysis, Benjamin Graham can be considered the father of value investing philosophy. The efficiency of their investment theories have been proven in practice, as Benjamin Graham was for 20 consecutive years, at least 2.5 points ahead of the Standard & Poor's 500 stock index. Few investors survived the 1929 crisis, and Benjamin Graham was one of them. He also made a wise prediction about the financial meltdown of 1973 to 1974. Benjamin Graham taught Warren Buffett at Columbia University. Warren Buffett, who is now one of the richest men in the world, with a fortune estimated at $58 billion, tried to work for the company of Benjamin Graham but failed first. Graham reserved part of the vacancies of his business to Jews who had difficulty finding employment on Wall Street. Warren Buffett offered to work for free for Benjamin Graham for a while. Over time, Buffett learned a lot from Graham on investments. Warren Buffett speaks of two important books required reading for those who want to be a value investor. One of them is the book Security Analysis, and the other is The Intelligent Investor, both written by Benjamin Graham. The book The Intelligent Investor is what has changed the way of investing. Warren Buffett had helped consolidate the philosophy of value investing in the United States. It is worth noting that we have a significant competitive advantage because our market is relatively new in the category value investing. As our peculiarities are being absorbed and studied, we are finding some discrepancies between price and value in several companies. These differences are called opportunities. Thus, it is up to each of us, investors, to know how to evaluate each of this opportunity and apply the concepts of value investing to get good results in the long run. The philosophy of value investing created by Benjamin Graham. Unlike speculation, which is the basis of the investment made through technical analysis where the primary objective is to profit from the difference between buying and selling prices, Graham believed that prices were not the best estimates for the real value of stock. According to his theory, prices and reflect investors' expectations about a company also reflect your fears and anxieties. The concept of Mr. Market, created by Benjamin Graham. This idea means that prices could suffer fluctuations that were not necessarily linked to practical factors. To these swings in stock prices, Graham gave the name Mr. Marketplace. In fact, what he meant was that the financial market often acts like a person who has his fears and desires. So when stock prices rise or fall too much, they reflect much more on the emotions of investors than information and accurate data on the stock and financial markets, and not fully capture the real value of the share. The real value or fair of an action and the basis of value investing. When it comes to fair value of stock, many people think that this is the value of the equity of a company divided by the number of shares outstanding on the market, less those held in treasury. However, the concept of value created by Benjamin Graham is deeper and more comprehensive. Unlike technical analysis, where the past data are used to try to predict the future, the philosophy of value investing created reverses this logic. For Graham, the share price of a company should reflect the expectations that investors have for future profits that the company will present, in fact, represent the expected future cash flows for the company. The expectation of future profits is fundamental because it is on that basis that investors plan to receive their dividends. So this expectation is imperative. It influences the price that the market gives to an action. The margin of safety. Of course, you will only buy a stock if you think your price will rise in the future, i.e., your purchasing decision builds in a margin of safety. What differentiates the concept of Graham is the size of this margin. The margin of safety is necessary because it is impossible to calculate the intrinsic value of a stock methodically so that it exists to absorb the effect of miscalculations or even a unique chance. All methods of calculating the intrinsic value involve predictions that may eventually prove not as accurate. Decisions based on this method, therefore, involve some degree of risk. The margin of safety for an investment is the difference between the fair price, or intrinsic value, and the current price of the asset. The goal of the smart investor is paying less than the value, less than the fair price for the asset. The larger is your safety margin, the greater the space maneuvers that you have not to lose money. It can be found by the following formula. Safety margin equals intrinsic value to current price, 1. What should be the size of the safety margin for it to be considered a sound investment? It depends on several factors, including market conditions, investor risk tolerance, and even the prospects for the company in question. When the investor is confident that his determination of intrinsic value is very precise, and it is unlikely that action undergoes substantial fluctuations, then a smaller safety margin may be appropriate. It is usually the case of large and well-established companies with a clear prospect of gains and records of stable cash flows. Try to determine an exact fair price to other businesses, particularly younger operating in volatile sectors, and it can be a tough task. In this case, prudent investors should demand a higher safety margin to compensate for the uncertainties behind the calculation. Lord Market. The value investing goes against the movement of most investors, and most know that it is even good. If all people would use this strategy, it would be much impossible to find discrepancies between the price and the intrinsic value of the shares. Discrepancies between the price and the intrinsic value of the shares. People are, for some reasons, not interested in cheap stocks. If all investors to buy only stocks with a margin of safety below the intrinsic value, the market would be efficient and quite stable. But we know that's not true. The market fluctuates a lot from day to day and has large swings in valuation over the euphoria and pessimism periods. Graham used a parable of an imaginary investor named Mr. Market to illustrate how an intelligent investor should take advantage of market fluctuations. Imagine that you own a share of a particular company. Do you have an imaginary business partner named Mr. Market who is willing to buy from you or sell you an additional interest at a different price he tells you every day? Mr. Market is an emotional man who lets his enthusiasm or desperation affect the price he is willing to buy or sell on a given day. But Mr. Market does not care if you take advantage of it. Sometimes it is lush and determines prices above the value of the business is worth. Other days he is pessimistic and puts a price below the real value of the business. In such cases, the difference between the price and the value of the quotas can be extreme. What a smart investor should do in this situation. Once he knows the real value of the business, when Mr. Market wants to sell at prices far below the value, it will buy his shares. When Mr. Market is looking to buy shares for more than they are worth, the smart investor will sell them to him. The same applies to the exchange. Chapter 2. The Concept of Value according to Benjamin Graham. To Benjamin Graham, a business has value when it creates value, or when its short-term assets without debts have real expectations of future cash flows. It means that the secret to identifying good investment opportunities is to define actions that are temporarily undervalued. This concept is imperative. It is through it that it is possible the idea of investing in value. Identification of stocks with potential to increase price and generate value, which shareholder also means the receipt of dividends. 3 pillars of value investing. The pillars of value investing is the idea that value and price action are different things, and is the basis of the theories developed by Benjamin Graham, and which are now used by many billionaires who invest in the stock market. In general, your ideas can be summarized in 3 key concepts. First, one must always invest with a margin of safety. This means that, as the financial market often creates distortions between price and fair value of an action, there are always opportunities to buy cheap stocks. And Benjamin Graham said that the important thing is not only to buy cheap stocks, but also buy a stock within a safety margin, a significant discount to their intrinsic value. Thus, not only it is easier to generate significant returns, as it is also possible to minimize the risk of variation in the share price. Graham was famous for the phrase, "buy a 1 billion with a coin of 50 cents." Second, the smart investor should seek to profit from market volatility. According to Benjamin Graham, contrary to what many think, falling markets are full of opportunities markets. According to him, the crisis is also times of exaggerated and momentary pessimism in the stock price, reflects somewhat distorted the actual condition of the companies. For Graham, the market or Mr. Market often acts irrationally, increasing or decreasing the share price when fears any more dangerous event. For this reason, one of the most important rules of the investor in value is never let emotions influence their decisions to buy or sell a stock. Third, the smart investor needs to know what is his profile. To Benjamin Graham, there are 2 investor profiles, active investors and liabilities. The investor profile, active or aggressive, would be the one who has the knowledge and the necessary conditions to identify and take advantage of buying opportunities or sell the financial market presents. But the opportunities that Graham saw were not speculation opportunities with prices buy low to sell high. The possibilities that Graham saw were to buy shares that were worth much more than its market price and make an investment becoming a business partner for extended periods of time. The idea of Benjamin Graham was a good investment, and it only makes sense when it generates profits in the long run. Based on this idea is that investors' assets should make their decisions to buy or sell a stock. An investor profile, defensive or conservative, would be one that would not have the conditions to position, i.e., take these purchasing decisions or sale. In this case, he could get lower gains from safer investments or price speculation. Chapter 3. Is there a need for setting value investing? There is, of course, a definition accurate than is value investing, the scope that philosophy has taken and the number of investors blockbuster that employ this philosophy, each in a different way. In common, it is possible to highlight the belief that actions have an intrinsic value, medium term, which may differ much from market value, giving rise to investment opportunities that exhibit a safety margin. The value investor usually seeks to evaluate their investment based on the benefits it can derive as a long-term holder of an instrument and not necessarily by the short-term movements in the price of the security or action. In most cases, value investors are oriented to the medium and long term and are skeptical of their ability to project the future with great accuracy. Graham himself made a very clear distinction between investing and speculating based on the above concepts. For him, investing is the activity of employing capital in financial instruments to earn them a direct economic benefit, say a dividend receipt of rent or a higher interest rate. Speculating is the activity of using capital instruments in anticipation of selling them to a third party at a profit. Different, is it not? A bit like buying something to use or just to sell in the future. The value investor likes to buy stocks to use. If you see an excellent sales opportunity in the future, that's good, but it need not necessarily have the presence of a buyer at a higher price in the future. The philosophy of value investing has become so notorious for success that many investors had to follow. Among major investors from one generation, a little older who follow, or followed when alive, this methodology are Irvin Kahn and Walter Schultz, Warren Buffett and Charlie Munger at Berkshire Hathaway, Mario Gabel, GMCO, Mason Hawkins, Southeastern Asset Management, Marty Whitman, Third Avenue. Among the investors of a generation slightly younger are Seth Klarman, Baupost, David Einhorn, Greenlight Capital, Prem Watsa, Fairfax Financial Holdings, and Bruce Flatt, Brookfield Asset Management. What are good buying opportunities in this context? Buying opportunities present themselves in different ways, and there is no rule. Over time, traders specialize in various kinds of occasions. There are value investors who specialize in buying very cheap stocks, sometimes because these companies have gone through recent difficulties or because there is an exaggerated perception in the investment community regarding a given risk, or because there is a shortage of capital in the market where it is negotiated. There are others who are turning more to identify companies that generate returns on invested capital high in their business, even if the discount at the time of purchase is not so great. Some investors like to identify a discount to the value of the assets of a company that can be difficult to analyze. There are even opportunities in situations where a company is heavily indebted, which are more risky but can generate very high returns and so approach options. Cheap stocks are related to their intrinsic value or long-term value of the asset. That is, when the market price of the asset is significantly lower than the intrinsic value, there is a buying opportunity. The greater the difference between price and value under Graham increased its margin of safety. Of course, the price of a stock is observable. There is a functioning market each business day. The intrinsic value, however, is an estimate of the investor. Despite the fact that this estimate may be grounded in a detailed analysis using objective data, it is not observable and therefore includes a level of subjectivity. What is the secret of value investor? Discipline, patience, and psychological strength. The trait that stands out most, for me, from these great investors is the mental and psychological training to analyze and develop their convictions, because often the value investor is the wrong way of a consensus. This position can be very uncomfortable psychologically by their isolation and corporately in front of customers. Very important, this discipline should not be confused with stubbornness or obstinacy. Discipline is essential for the investor to analyze and develop their studies and investments by their convictions and results. Often, the value investing presents investment options that go against the grain of many market analysts. At this point, the discipline and focus are critical for investors to apply their capital respecting their studies and not be carried away by the herd effect. Patience stands out for waiting time until their mature investment. The competitive advantage that you saw in the price or value of the analyzed company can and probably will view belatedly by the market. Patience and perseverance are essential in these times. Last but not least, the psychological strength. It is important that the investor may face opposite positions to the market, which can be uncomfortable from the psychological point of view. At this point, it should be noted that the discipline and mental force should not be confused with stubbornness or determination. It is crucial to possess humility and discipline to recognize their mistakes and learn from them. No wonder that the greatest investors of all time built their fortunes 100% supported by value investing strategies. Chapter 4. Concepts and stories that exemplify what is the value investing. The most famous value investor you know is Warren Buffett. In this traditional annual letter to Berkshire Hathaway investors in 1996, Buffett said that to invest successfully, you do not need to understand complex concepts or master the technical analysis. In our view, referring to him and Charlie Munger, real investors need only learn how to evaluate a company and how to think about the price of stock. There seems to be a perverse trait in humans trying to hinder what is easy. I am a better investor because I am a business person, and I am a better business person because I am an investor. Investing based on value investing is becoming a partner of excellent companies. A fundamental rule for the investor who follows the teaching of Benjamin Graham is to analyze companies as if evaluating a possibility of becoming a member of a big deal. That's exactly what happens when you buy a stock. It seems silly to say, but many forget to follow this important premise for success when they ignore everything that concerns the financial health of a company and its prospects to focus on graphics and the hot tips randomly, or simply do not take its investor career seriously. Follow the value investing is to invest in businesses that you like, you know, and trust. The value investing like Warren Buffett and reminder at the beginning of this text is simple, logical and rational. Your goal when investing should be to buy the stable prices, stocks of companies whose businesses are easy to be understood and whose that profits tend to be exponentially greater in a horizon of 5, 10, 20 years. If you're not willing to pass an extended period as those with an action or consider buying it, either invest in the stock market. Investing in value is hunting discounts. If you are one of those people who only buy products on sale, know that within you there is already a value investor. Not always buy a share of an exceptional company will generate the best results in the long run. For this to occur, you must know that you are buying the share at a price below its real value. It is called the margin of safety, one of the pillars of value investing. Act as a deadly predator. The value investor will always buy extraordinary business actions, and it is true, but that does not mean he will buy them at any time. You have to find the balance between price, value, and time in the same way as they do the great predators of nature. Just as the animals sniff, pursue and analyze the prey, monitor the environment and wait for the right time to attack, the value investor manages its investment decision. Please do not forget that the market is not efficient. If we know that irrationality prevails and that volatility is one of the main characteristics of equity, why should we believe that the current price of a stock will always accurately reflect its real value? It is where comes into play a character that good value investor is keen to ignore. The often apocalyptic economic news which exerts a strong influence on the actions, sometimes positively, others negatively. However, when you know the ways of value investing, it is not difficult to understand this schizophrenia, become oblivious to it, and find value stocks in the chaos. Every anonymity is dumb. The herd effect is responsible for many victims in the stock market. In general, investors who do not seek to develop their knowledge and skills to invest are easier prey. Never forget that irrationality will always give the reins in the short term, and it can be tempting to go to the same side that everyone is going, but that value investors take a contrary stance to the herd. Briefly, they buy when everyone is selling and sell when everyone is buying. It is a similar logic to buying Christmas presents in January when the shops are empty and retail granting substantial discounts. Chapter 5. The 10 Commandments of Value Investor. First, while a company continues to operate normally, it has an intrinsic value based on the company's business potential to generate and distribute profits. This intrinsic value is not an exact value, but a range of possible values that moves in time. In cases where a company's past results show a trend relative stability, the track can be identified with reasonable accuracy. Second, the bag is not a mechanism to evaluate actions, but a collective entity subject to various emotions. Accepting the opportunities to take advantage of their moments of panic, the bag for the value investor, it is simply a place where he performs his purchase and sale transactions. Third, thus, over the years, the value of a company on the stock market fluctuates around its intrinsic value, in many cases deviating from this value, particularly when the stock market as a whole is down, for prolonged periods. But as the stock market is reasonably efficient, there is always a value of the trend on the stock market return in the medium to long term to the intrinsic value. Are the periods during which the intrinsic value significantly exceeds the value on the stock market that offer excellent buying opportunities. Fourth, as it is not possible to calculate the intrinsic value of a company with precision, and as the future trajectory of the company is subject to a variety of influences, many negative, it is important to buy a stock when its price offers a significant discount to their intrinsic value. This safety margin will minimize the chance of loss and maximize the possibility of gain. Fifth, to calculate the intrinsic value of a company is necessary to analyze its trajectory over at least 10 and ideally 20 years to establish a basis for projecting future profits. Due to the wide dispersion of results, however, many companies do not lend themselves to this type of study and must be rejected as investment options. Sixth, if an investor has the time and expertise to identify good companies with a great ability to generate profits, and if it finds its shares for sale at an attractive price, it must invest a significant percentage of their funds in each company. Such discoveries, they are rare and offer higher gain opportunities. As a result, this investor will have few companies in its portfolio and will keep for many years. As their investments will be concentrated in a few companies, the investor should know these companies in depth and closely monitor the development of their business. Seventh, if however, the investor does not face their investments as a full-time occupation, he should emphasize techniques to minimize the risk. It should focus its attention on companies that are prominent in its industry and have a strong financial position, substantial sales, consistent generation of profits and dividends, reasonable growth and indicators price or earnings and price, or equity moderate. It should establish a portfolio with a minimum of 10 companies. Thus, diversifying the risk, the average performance of your portfolio offset errors of assessment or impact of contingencies in case some of your choices. Eighth, but most important of all, the retail investor should take steps to avoid paying dearly for their actions. He has two alternatives. The easiest way is simply to ensure average market prices. To achieve this, it invests in the purchase of shares, equal values at regular intervals, a month, a quarter or a year, over the years. Although the return to appear tomorrow, this investor should consider an investment horizon of at least 5 years. It is the natural tendency of good companies to grow their profits, and these are reflected in the valuation of its shares, which provides the margin of safety of this approach. Ninth, in the second alternative, the small investor takes a more active stance. It establishes a wallet from a strategy among many to try to identify undervalued stocks based on their market indicators. It can, for example, only invest in stocks whose indicators price, or earnings and price, or equity is below predefined limits. It is the discounted share price discount evidenced by the indicators that represent your safety margin. Paradoxically, it has no guarantee of obtaining an additional return as a result of their efforts. 10th, whatever the technique adopted, any investment program must necessarily include the application of 50% of their funds on average, and never less than 25%, in fixed income. In addition to providing a cushion for emergencies, fixed income complements equity, often increasing the return of equity decreases, for example, and vice versa. To a given company at a given time. It may be greater or less than the actual value of the enterprise. Especially in the stock market, the law of supply and demand works too hard. If many people are selling a stock, the price of it falls. If enough people are buying, the price of the same stock rises. However, the value of the company remains the same, and the company has not become better or worse in the low or high of the share price. If it is a stable company, it remains stable. If it is profitable, it is still profitable. Thus, value investing refers to make a qualitative analysis of the company in which it intends to invest. The investor of this type of the principle that buying shares is becoming the partner of this company. Because of this, he must believe in the growth potential of the company, or his investment makes no feeling. Understand the concept of value, which is better, to buy shares at a price below the value or above the value. Of course, it is better to make the purchase with a price below value. Importantly, in value investing, you should consider the purchase of shares actually as an investment in the purest meaning of the word. That is, the investor buys such shares because he believes in the value of a particular company and wants to be part of the same owner, i.e. to be a member. If you invest in a good company, the ups and downs of the stock price should not affect you, because regardless of the stock price, the company's value follows the same. Chapter 1. The Father of Value Investing. Introduction. The concept of value investing came in 1934 in security analysis work of Benjamin Graham and David Dodd. Later, Warren Buffett, coached by Graham, was to become one of the richest men in the world and considered by many the best investor of our time, using the concepts of value investing. Because of this, Buffett is considered the leading popularizer of value investing. The first point to be savvy when it comes to value investing is the difference between value and price. Value is something intrinsic to the company, i.e., a company has high or low value depending on its quality as an organization, regardless of its current price. Price is the monetary amount which the market is assigning. Benjamin Graham, the father of value investing and fundamental and valuation analysis, was famous for being teacher of billionaire Warren Buffett. If you want to learn how to invest well in stocks, you need to know Benjamin Graham and his investment philosophy in action. Why is Benjamin Graham important? Every investor who starts their investments in stock exchange always faces the debate: what is best, technical analysis and value investing? As Charles Dow can be considered the father of technical analysis, Benjamin Graham can be considered the father of value investing philosophy. The efficiency of their investment theories have been proven in practice, as Benjamin Graham was for 20 consecutive years, at least 2.5 points ahead of the Standard & Poor's 500 stock index. Few investors survived the 1929 crisis, and Benjamin Graham was one of them. He also made a wise prediction about the financial meltdown of 1973 to 1974. Benjamin Graham taught Warren Buffett at Columbia University. Warren Buffett, who is now one of the richest men in the world, with a fortune estimated at $58 billion, tried to work for the company of Benjamin Graham but failed first. Graham reserved part of the vacancies of his business to Jews who had difficulty finding employment on Wall Street. Warren Buffett offered to work for free for Benjamin Graham for a while. Over time, Buffett learned a lot from Graham on investments. Warren Buffett speaks of two important books required reading for those who want to be a value investor. One of them is the book Security Analysis, and the